Welcome back to the Lance Roberts Podcast. We're just wrapping up an interview with Larry Lepard today, and we left off just before the break talking a little bit about, where you are positioned now. We talked about that, you were talking about how great an investment opportunity ultimately gold and silver may very well be when the system actually does come apart at the seams, and the question becomes, is that potentially what we're seeing now? These topping processes take much longer than people expect. And of course, during a topping process, nobody believes that this time is different. They believe that, we're at permanently high valuations. This is simply a buy the dip opportunity, as we were talking about earlier. But the reality is we are seeing some early evidentiary signs that this decade-long bull market may be nearing its end. What do you think?
I don't think there's any doubt that the top is in for the stock market. I mean, absolutely zero doubt. If you look at the FANGs, which are the leading sector in the market, and you look at the charts on the FANGs, I mean, they're all blow-off tops and corrected down below the 50 and 200-day moving averages. Now, bouncing right now, but there's, stick a fork in the stock market. You can't bring that wealth back, and they don't have the tools to reinflate it. And by the way, they're not even trying to reinflate it. They're actually trying to build up a reserve of interest rates that they can drop when the next crisis really becomes serious, which it will, but it's probably going to take another 6 months or a year to do. But I don't think there's any doubt that there are cracks in the facade of the bull market in stocks, the bull market in bonds. I mean, interest rates are going up. We've had 35 years of disinflation. One thing I think would be helpful to your listeners to understand, I was investing in 79 and 80, and I'll never forget that the Zeitgeist at the time was so very clearly that gold and silver are where you got to be, and oil too, because there's been just so much inflation, and inflation is never going to end. It's just an ongoing problem that will be with us for the rest of our lives. So buy some gold and silver in 79, 80, 81. And bonds, oh hell no, you would never buy bonds, because bonds are certificate of confiscation. I mean, during the 70s, anyone who had a long bond got killed. Stocks, same story. They haven't gone anywhere for years. Business Week, the death of equities in 1979, right on the cover, And so, by the way, at about that period of time, those would have been really good things to do. It would have been really smart to sell silver and gold, and really smart to buy bonds and stocks. I mean, I know people who bought strip 10-year treasuries at 10% yields that got 10 baggers on a bond.
Right.
Admittedly, a bond strip. And in turns, so turn that to today, we've got the mirror image, right? Gold, silver, what are you kidding me? Those haven't worked. That's a terrible area to consider. Stocks, everybody knows you buy the dip on stocks, and look at how well they've performed, and they're going to continue to perform. And inflation, by the way, we're never going to have inflation again in our lives. I was at this conference where Larry Summers, Tim Geithner, and Paulson were all there, and they're all talking about something that they call a negative 4.5% R-star, which means that we have to have negative real interest rates of 4.5% to get some growth. And Summers was calling for more money printing and more deficit spending. And he said, and you know why we can do that? Because inflation has been, destroyed in our lifetime. Inflation just is not a problem. And I thought to myself, oh, hallelujah.
Dilly, dilly.
I mean, they're ringing the, Larry, you're ringing the bell, man. This is perfect. You are the perfect contrarian indicator.
Right.
You know what I mean? Because I think inflation is going to come. I mean, one, inflation's already here, and most of your listeners probably already know that. Certainly they do if they pay for health care. Also just the government inflation statistics are cooked. Go to the shadow government stat statistics. I mean, it's 6-7% higher than what they're showing, the government numbers are. But, you can see it everywhere. I mean, I talk to, people in the Midwest who are in the manufacturing, but they say we've got cost pressures everywhere. And so what I see coming is very much what, I was a teenager at the time, but I see the 70s returning, which is, people say, well, the price of oil is falling, there can't be inflation. Well, perhaps, and certainly we could have soft demand when this bubble bursts and we get a downturn. And maybe the price of oil will go down a little bit, but, inflation and everything else is just going to be a barn burner. And the reason is that all of the paper money is going to start to transfer over into goods. And there's a great chart. If you go to Google and put in, commodities, Goldman Sachs Commodity Index versus S&P, you'll find a chart in there that shows the extreme that we're at. And, the stock market is outrageously overvalued compared to commodities, or commodities are outrageously cheap compared to the stock market. And this isn't rocket science, folks. I mean, it's just, and you've got to take more than a 1 month or, couple month view. I mean, I find it hysterical the way people get all jazzed up, or, the stock market fell, it's going down, the stock market's up, it's going, I mean, no. Get the big picture right. And these zigzags are, you can ignore them. They're just, you got to be on the right side of the long-term trend. And in my opinion, the long-term trend is for higher inflation and lower financial asset prices, because they're both at very, very extreme, overextended levels. And that chart that I referred to shows that.
Yeah, and now this is an interesting conundrum that I wrestle with personally.
Okay.
Because, all right, so we have an economy that's heavily leveraged in debt, right? So if we take a look at government debt, we take a look at consumer debt, we take a look at corporate debt, which a lot of it is now, less than investment grade quality. Oil and gas drilling companies that are sub-marginal companies have been taking on a lot of debt at low interest rates to go and drill really non-productive wells, et cetera, particularly the shale fields, which have very high depletion rates. So here's my conundrum. I don't disagree with your premise that commodities are extremely cheap, and we're going to see a transfer into asset prices that are in commodity hard asset prices versus ethereal asset prices like stocks. And I don't disagree with your premise at all about higher interest rates. The government keeps jiggering with the inflation numbers so they don't have to increase the rate of Social Security payments, which would only accelerate the pace of bankruptcy for our welfare system. So, but here's the conundrum.
I know where you're going, but go ahead.
So inflation goes up. Historically speaking, if inflation is rising, interest rates should follow. And the problem becomes if interest rates in the 10-year Treasury, as an example, which is kind of your benchmark for mortgages and auto loans and everything else, if that rises much from here, we're going to be talking about major suppression for 80 to 90% of the population of being able to consume. We're talking about accelerated bankruptcies, another housing crisis, et cetera. So is it possible to have rising inflation with not rising interest rates?
Yeah, I know what you're talking about. What you're talking about is this bubble's going to burst, things are going to break, and that's going to be a deflationary impulse because people have to pay back debt, they're going to lose their jobs, and there's no doubt that there will be some of that coming, that the demand side, I mean, there are two types of inflation, okay? In my opinion, there's inflation driven by just sheer demand growing and supply not growing as fast, and therefore, the prices go up, right?
Right.
There's another kind of inflation too, though, that's the inflation related to where the great stock of money, quote unquote, flows, and and they're going to be cross currents, right? We don't know, and I don't know how this is going to unfold. Nobody does, okay? But yes, the price of oil could go down because people are losing their jobs and everyone's driving less. Okay, fine. That's a down pusher on the price of oil. And by the way, some shale oil companies could fail, and those guys who are unemployed, they're not going to be buying as much either. Okay, so those are all deflationary things. However, on the flip of that, the prices also get set by input prices and where the assets are going. Okay, so let's and so we're talking about there's kind of goods inflation based on how the economy is doing, but then let's go over and just look at the financial asset side for a moment. Right now, people are buying stocks, and people, or until now, I should say, people have been buying stocks and buying bonds because they figured things were disinflationary, right? That those were good places to be.
Correct.
Okay. Right. What if they suddenly see that two things are occurring? One, the prices of those things are going down, which has kind of started. I mean, bonds, interest rates are going up, prices of bonds are going down, stocks have started going down, just getting started. Okay. And more importantly, they also start to think to themselves, they see other things that are fixed going up in price. So, for example, and you've seen this, wheat is broken out, corn is broken out, you see, and those aren't as sensitive, by the way, to demand. I mean, people are going to eat no matter what, right?
Sure.
And so what if you start to see the other prices are going up? The price of silver is going up. The price of gold is going up. Things that can't be printed, things that aren't financially driven, those prices are going up. And then suddenly that starts to become reflexive. So the guy who's seen his stock portfolio gone down and sold some of his stock, and by the way, so the price of gold is going up, the price of silver is going up, the price of wheat's going up, the price of corn is going up, the price of soybeans. Well, that's a bad one because of the China thing. But other things are going up in price. that's inflation, right? And so some of these people who are holding assets that are going down are going to say, hey, I want to hold something that can't be printed, and they're going to start to shift their preferences and come to this. And suddenly, people are going to start to recognize that pattern. And then, by the way, they're going to say, oh, well, okay, so the price of all these inputs are going up, and interest rates are going up. Well, gee, maybe I shouldn't own bonds. Maybe I should sell my bonds and buy some of these inputs. And so pretty soon, just the basic input price inflation acceleration can drive it through the system, even though the demand is soft. Do you follow what I'm saying?
Yeah, I do.
So there's a financial shift that can take place and can drive inflation. I mean, I don't think demand during the 70s was particularly robust. I don't think America was experiencing big growth rates during the 70s. And yet, we got to 12, 13, 14% rates of inflation. Now, some of it was driven by a couple of oil shocks earlier on, but more of it was driven by all the money from guns and butter eventually working its way into the system. That's the other thing that I see going on that I don't think people have understood or discounted. We printed a boatload of money, and I thought, well, wow, we print this money and gold is going to 5,000. This is what I thought in 2008, and of course I was wrong. It takes time for the money to work its way into circulation, to get off the bank balance sheets, for the velocity to turn up, for people to start behaving in a way that says, oh, I want to have inflation hedges. And so, there's been a lag here, just like, if you think about it, the Nixon shock and in 71 and the Vietnam War, which led to a lot of debt and money creation from the mid 60s to 71, it was that money that created the 1978 14% inflation. So there's kind of a 10-year lag there, right?
Right.
And so we created, what I consider wild financial mismanagement started in this country in 2008. There was stuff before that, but 2008 was like over the top, right? We're going to take the Fed's balance sheet and quadruple it. Really? What were they thinking, right?
Right.
And so that money hasn't, and I thought it would be instant inflation. It hasn't turned out that way. It just hasn't for a variety of reasons. But they're not going to be able to shrink their balance sheet. They're just not. And that money, they're starting to in a very, very minor way. Yeah. And that money is going to work itself into the system. And I think once we get to a certain point that the zeitgeist has changed from and what you see a lot of very smart people saying, the bond bull market is over. To me, that's the real trend. The thing that made all these financial assets work so well from 1979 or 80 to the present, to 2018, was that we had falling interest rates.
Right.
And, really since 15, 16, we haven't had falling interest rates anymore. And I don't think people quite accept that yet. I feel like we're kind of in an 82 period where, we were in a bull market for stocks, but people still didn't quite get it. And there was a lot of cross currents right now.
They didn't believe it in 82. They just come out of the 74 bear market, which, by the way, we focus on the 74 bear market, but everybody forgets there were two bear markets right before that as well. The 74 was just the biggest of the three. So after 2 decades of not making any money, people are like, bull market, whatever.
Right.
But it is interesting, where you are right now is that as we look at this and talk about bonds and stocks and where the markets are, people haven't really gotten the idea of this. I just published a chart today that is actually showing the shrinking of the Federal Reserve balance sheet. And you're seeing it finally roll over. And from the point that it began to reduce, we got into this major financial turmoil this year.
Right.
And so it can only be understood from just the action so far that this continued shrinking of the balance sheet, if they try to complete it, is going to be much worse than what people currently expect.
I think that's absolutely right. I think that people have not accepted that the trend has changed and that the tide is going out on low interest rates, low inflation, and elevated stock prices. And that the implications of that, to me, are quite obvious, and it is that inflation will pick up, and therefore inflation hedges will work. And if you look back at the 70s, and I've done it very carefully, from 1970 to 1980, the two best performing asset classes were gold stocks and oil stocks. And these are companies that produced an underlying commodity that appreciated massively in price, because the companies are leveraged to the commodity itself because they represent a stream of future claims on the commodity, and they can produce it. And that's what my fund is full of. I'm full of the very best gold mining companies in the world, and there are hundreds of gold mining companies in the world, many of which are junk. But I've, since '08, I've spent all my time meeting with managements, going to conferences, reading publications, and sorting through gold mining companies with the goal of finding the very best names. And if I'm correct about this trend, once the price really starts to break out, and there are a couple of important levels. I think 1270 is an important level, 1350 is an important level. Once we get through 14 and change, then it'll be obvious to everybody. And I think, the way these miners are beaten down, I mean, they're so leveraged to the underlying commodity price that, there are 10 baggers laying around right now. I mean, I'm buying them, and now, but what I can't say is I can't honestly say it's going to happen in 6 months or 2 years. I mean, and anyone who follows this or looks into this area does really need to be be patient, because it is important that you could have a setback here. I mean, you never know, right? I mean, markets are very, very volatile and hard to predict. But I do feel strongly that the right side of the trend to be on is the one that I'm on, or the side that I'm on.
Yeah, and let me wrap up our interview today with this quote that this is from your newsletter that you just published here recently. It says, "If you do not own gold, there's no sensible reason other than you do not know history, or you do not know the economics of it. Over long periods of time, the price of gold approximates the total amount of money in circulation divided by the gold stock." That was from Ray Dalio in 2015. You conclude by saying gold represents a unique form of financial security in a turbulent and extreme market climate. It's monetary insurance, and all portfolios should hold some. I mean, that pretty much sums up the majority of what we talked about today, is that this entire financial climate we are in has been driven by excess liquidity, leverage, all the things that have historically, throughout history, you go back throughout, entire centuries, have always wound up bad, whether it was Rome or Greece or the United States today, and we're seeing the same things again. So,
well, and if I can, Lance, let me just add one thing to that. It doesn't take a lot. One of the ideas I want to get across is the notion of asymmetry, and that is that, you don't need to take 100% of your money and put it into gold. I mean, that'd be insane, or into gold mining companies. Right. But to have zero is really a mistake. Because in my opinion, the downside in the stuff that I'm doing is 20%, and the upside is 200 to 400%.
Right.
And so, even a 5% allocation of somebody who has some capital, that 5% is going to move the needle, and you're going to be glad you have it if what I'm, talking about unfolds.
Absolutely.
So, I mean, it's not a matter of all or nothing in this stuff.
Absolutely. Larry, thank you so much for your time today. We appreciate you very much, and hope to have you back here as things start to develop.
Oh, that's great. Thank you, Lance. I'm really impressed with what you guys have done, and I appreciate the forum to talk about what we're doing.
Well, we'd love to have you anytime. So anytime you got something to say, you let us know.
Will do. Thank you, Lance.
Thanks,
Take
Larry.
care.
As Larry Lepard, of course, you're listening to the Lance Roberts podcast right here at realinvestmentadvice.com. And, of course, as always, subscribe to our YouTube channel, Lance Roberts Show at YouTube, or on our website, realinvestmentadvice.com. Just click on the podcast tab, download this interview along with all of our others to your favorite iPhone or Google device, and we'll see you next time on the Lance Roberts Show podcast.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com.
It's a rich man's world.